this computer. All right. Yep, it's recording. That's good. All right. All right, here we go. Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, and today I'm joined with Randy Hargett, owner of Capstone LTC Advisors. Hey, Randy.
How you doing, Casey?
So Randy was a guest on episode 16 back in 2020. That was a long time ago, it seems like, but maybe not that long. Randy, you got a wealth of knowledge about long-term care. You're a Ramsey trusted provider through the Dave Ramsey show. And today we're going to talk about protecting your wealth using life insurance or insurance in general. Thanks for joining us.
Well, thanks for having me. 2020 does seem like a long time ago.
Actually, I think this is your third time because I think we did two in a row back then.
Yep, I think we did.
So thanks for joining us. Our legacy, our theme this quarter is legacy planning. And so I wanted to make sure that we circle back around to talk about insurance because I think that's such an important part of preserving one's legacy. And I know that, listeners, I'm sure have gone back and listened to all our podcasts, but just in case they haven't,
right.
Let's start with the basics, Randy. Let's talk about different types of life insurance. I want to cover life insurance, long-term care insurance, all things related to preserving one's legacy. But let's start with the basics. So people often get permanent life insurance confused with term life insurance. So when we start with the one I prefer, which is term, and kind of describe that.
Well, term life insurance is a life insurance policy that has a limited lifetime itself, and you can do an insurance product that would last anywhere from 5 years to 40 years. And choosing that term has an effect on the price. For example, if you have 7 years left on your mortgage, you might want to purchase a 10-year term life insurance policy to cover that mortgage should you pass away. And then after 7 years, when the mortgage is paid off, you don't need that particular policy anymore. Mm-hmm. And so term life insurance is usually designed and purchased for specific reasons. A lot of people years ago, and there's still a lot of people that buy whole life insurance, but whole life insurance is a different animal. Term came around and people started realizing that term life insurance was so much less costly that they could buy a term policy, give themselves that protection for that specific reason, and be able to invest the difference in the cost between that and a whole life policy. And that was going back into the 70s was the big phrase: buy term and invest the difference.
Right.
But basically it all comes down to what an individual's needs are. Do you need this kind of protection? And then it comes down to a question of, do you want that kind of protection? Because essentially people buy life insurance because they love their families.
I guess I look at it as I want the cheapest way to replace my income because, and with the assumption at the same time I'm building wealth. So at some point you've built enough wealth that you don't need life insurance anymore. And that should cross over about retirement age or maybe a little bit past that. And so that's the philosophy that I've taken here. Now, a few episodes ago, we had a good friend, Gary Bottoms, on our podcast, who runs a benefits company here in town. His son more runs that. He focuses more on permanent insurance. And so he's very adamant about having a permanent policy in place so you can spend down your assets, but then have this remainder left over to cover your loved ones after you're gone. Why don't we talk about that a little bit, because typically the most conservative way to approach that would be whole life.
Right. That would be the most conservative and most expensive way to approach that. And the whole life insurance policy does cost quite a bit more because it does build a cash value. And as you grow that cash value, you have access to it. You could borrow against it if you needed to borrow, and then when you paid it back, you'd be paying yourself the interest. And so there is a whole industry out there of people that promote whole life insurance as a way to finance your life if you wanted to be able to do that, especially if you were able to purchase a whole life insurance policy with a single premium. Now, to
Yeah.
get to specifically what you're talking about, what we typically recommend is what's called um, not term life and not whole life, but called universal life insurance. And a it's a kind of a hybrid between whole life and term, in that you get to pick the term. In fact, the term can go out to age 120, so you could actually guarantee yourself a death benefit. But
Mhm.
typically, universal life does not build cash value. And so you could get that replacement wealth, or that replacement of what you've spent down through a universal life policy at a lot less cost, especially if you did not have the need to build a cash value or have something to borrow against. And so
Right.
we have more clients that will look at a universal plan than a whole life plan because of that, because it's more cost effective. And you can actually, instead of picking a 30-year term, if you're 60 years old, you could pick, I want to make sure that this is paid when I die. And so I'm going to carry this out to age 105. And so you get to choose the age that this universal policy would expire.
Yeah.
That being
It-
said, a lot of people these days are doing exactly what you talk about and have life insurance in place to replace a retirement income should they not be able to continue toward retirement. And once retirement hits, the need for that particular plan is no longer there.
so universal life for business owners, do you see that being used uh, as the key man insurance?
Yes, that is a good type of key man insurance. Um, Especially when you're doing something else with your money and you don't want to put it all into a whole life product that's
Yeah.
cash value over here. You'd rather have your
Right.
cash in your business.
But the
And
universal
so
life, does it not have an investment component to it, or is that just in variable life?
there are some universal products that allow you to have an investment component to it. Typically, we don't utilize that. We utilize universal for people that aren't worried about building a cash value. But if you really wanted to generate wealth with life insurance, a variable life insurance policy is a good way to at least consider, um, because you do have the ability to grow that cash value with the market.
Yeah, with some limitations though. I mean,
Right,
you're not getting well, typically it's higher expenses. That's the limitation.
right.
So,
That's exactly right.
and also too, we don't see this anymore, but many years ago, the death benefit or the death tax, the inheritance tax, it would kick in at $500,000, which is really, really low. And so you would see people buy universal life or whole life to cover the tax liability for their loved ones, because you're basically paying that tax at a much smaller rate than if you had to pay for it in the future. But the reality now is that you have to have, as a couple, a net worth of over $22 million before you'd have to really worry about paying any of that. So it doesn't make sense from that standpoint. I mean, there are rumors that certain political groups want to lower that, but it hasn't been done when there's been
Right. Well, that's the whole purpose of having a review with you on a regular basis,
right.
because those kinds of elements are sometimes a moving target. Um, I will add this: a lot of term life and universal life products have added features that allow people to purchase that not only for a death, but some of them now have features that the death benefit is accessible while you're alive if you got sick, if you had terminal cancer or things like that. And so that is another element in play here with term life insurance and universal life insurance that people can consider. Not only can it benefit at my death, but it could prevent me from losing some assets to a serious health event. And so, because most policies allow for what we call a living benefit for
It's
especially
basically you've been given a terminal condition, and it's a way to settle up your affairs before you pass away.
That's exactly right.
Yeah. So have you seen the implementation of that? I could only assume that there's some serious doctor letters required for.
Yeah, it does have to be. It does have to be documented that this is terminal and that you are going to, typically for most policies, it's a 12-month window, that there's no chance that you're going to live beyond 12 months.
Yeah.
And in most cases, it's not the full death benefit that's available. It could be 25% of the death benefit, 50, 75%, depending on the product. And so,
something else, Randy, I've come across in the last couple of weeks is clients that have term policies. Northwestern Mutual is really good at selling these. It has not a consistent premium, so it'll step up in premium every few years. But their big thing at the end is you can convert it to a permanent policy. And the cost of this policy is a lot bigger than just a standard old non-convertible term. And to me, it's okay to disagree with me, but to me, that seems really great for the salesperson, because the person who bought it probably has never considered converting to term, and they probably didn't fully understand it, because when I sit down with the client, they tell me, oh, I got this term policy, and I start looking at it going, oh my gosh, you're paying $1,200 a year for this. I think you gave them a quote of $800 something a year. I don't know. It was Michaela here in the office did the analysis for me, but it was thousands of dollars savings in premium because of having a less complicated term, a much more simpler term. What is your take on that? I don't want to necessarily bash those agents. Their job is to provide for their families, not necessarily.
My take on any kind of life insurance basically is one-fold, is that life insurance, any life insurance policy, needs to be purchased for a specific reason. You don't need to just have it because, oh, it makes me feel good. Life insurance needs to be purchased for a specific purpose, whether that purpose is to protect your business, or if it's to generate an income to stream for your spouse, or whether it's to, a purpose is to leave a legacy as well.
Yeah.
And so when you think about that, it really causes, at least our clients, it causes them to really take some time and meditate and think about why you need life insurance. And once you get to a point where you don't really need that life insurance anymore, that does not have to be a part of your budget.
Yeah, right.
And so it's really important to identify the need and then design the coverage to meet that need.
And ultimately, in our planning software, that's exactly what we're doing, in that we are trying to replace income that's needed, the needed income, not excess income, but the basic needs income, while they were working during their working years, and then provide the retirement that we've been planning for. And it's basically it's a step approach. You need more now, you need less later, and you know this. Sometimes we do two policies. Maybe it's $1 million policy for 10 years, and it's a $500,000 policy for 20 years. But we understand where we can save money by staggering the expiration dates and how we build that.
Absolutely, because a 10-year, $1 million plan is not nearly as expensive as many people think,
right?
Because of the 10-year term, but it's meeting a specific need, and it's different for every individual. I have quite a few clients who have purchased life insurance policies, especially universal life insurance policies, because they have a family member that's got a special need.
Absolutely.
And they want to be sure that family member is taken care of when they pass away.
Yep.
And so it becomes an individual situation. It's not a one size fits all, and it really needs to be evaluated in, like, your software or in a special financial analysis to say, okay, here's where we need to be sure that we're taken care of if a death occurs for either one of you, if we're talking about a couple.
Yeah, that makes sense. So let's shift gears a minute. Thanks for walking us through that. I don't think a lot of people fully understand the differences between the different policies. Let's make it more complicated. let's talk about
Okay.
let's talk about long-term care. So you think about you've been saving well your whole life, or you've sold your business. You don't really need life insurance anymore, but you still are not quite out of the woods on just coasting through the rest of your life, because we're all living longer, but we're not necessarily living in the best medical health condition. And
Yep.
so we've seen, baby boomers, are a lot of them are, I think, probably don't have enough, have not put enough thought into what happens when they have to end up in a nursing home. Assisted living is really not horribly expensive. But it's the nursing home that really hits the budget hard. And you're looking at what, $800 a month here in Georgia or in the metro Atlanta area for
Yep.
memory care. And that rate's growing somewhere between 4 and 5% a year going forward.
And so you can easily see how 1 year in a nursing home could take $100,000 out of your assets.
Yeah, that's just to live there.
That's just to live there. But I think the key ingredient that you said is that most people have not thought about this. And the reason is most people don't want to think about this.
Right.
Okay.
Yeah,
nobody wants to think about it. And if you do play that tape out to the end, especially if somebody has most of their money in qualified funds,
right.
and if the nursing home is going to cost them $100,000 and they have to pull that money out of a qualified fund, then that nursing home is going to cost them $125,000.
Right.
Because they've got to pay taxes on that money. And so most people have not played that tape out to the end. And the reason they haven't is because they probably haven't experienced it. I've been doing long-term care exclusively for about 20 years now. And what I can tell you, Casey, is that probably 80% of our clients are people who have experienced a long-term care event with a parent or a grandparent. And they've been forced into thinking about that.
Yeah.
And so It really goes back to your statement, is that most people haven't thought about it. The ones who've been forced to think about it end up addressing it. And so, and that's really why I'm in this industry. I'm a chemical engineer by degree. And both of my grandmothers went through $900,000 in a nursing home. And the other reason that is kind of hard for people to think about is the actual numbers are pretty staggering, because half of the people that go into any kind of chronic care situation die within the first year.
Yeah.
Which means that it's not long-term, and it's not a long-term financial burden. It's not a long-term physical burden on the family. But if you do make it beyond 1 year in a chronic care setting, the average is between 5 and 6 years. And so that's really where, a lot of people should be thinking in their planning, is to protect against that catastrophic.
That's interesting, because I even tell people the average stay in a nursing home is 3 years. But if you eliminate that 1 year, you are right. It would push the average up to 5 to 6 years.
And for people that are watching this that are numbers folks, it's actually 2.6 years is the average. But it is heavily weighted on both ends of the bell curve.
Yeah. Yeah. So you're either there a short time or you're there a long time.
That's right.
So, there are points where, and this is, we take our clients to, once we finish the planning process, we go back to insurance and say, okay, how do we protect all this? For the long-term care analysis, we show them, this is where you were, or this is where you'd be at age 80 and 88 if you were in a nursing home. This is what your wealth would look like if you didn't have to be there. And this is what your wealth looks like with the burden of these payments. And I often tell people, you're going to have your Social Security. It's not like you're going to be leaving the nursing home to travel or to eat out. So everything's pretty much centered around that nursing home cost plus your healthcare costs, medications and such, doctor's visits. So you look at your Social Security, maybe you have a pension on top of that, this guaranteed income, and then what your portfolio can support. And then above that is what you have to insure. Uh,
That's right.
and that varies. I mean, a lot of times it comes out around 4,000 a month is all they really need. Other times they need more than that. It just depends. And then the question is, do you want or do you want to make those premium payments? And I think you and I have agreed on this in the past. If you have to buy long term care, but then you can't take the grandkids out for ice cream because you can't afford it, we
Yep.
just need to play the Medicaid the Medicaid card, not the long term care card. Uh,
That's right. And from our perspective, that's the way we've been from day one. Is that, if purchasing long-term care insurance will force you to change your lifestyle to pay that premium, then you don't need to buy it. And
right,
so that's really where we are, and we tell people that all the time. Um, what we
but
do also encourage people to not take a one data point approach to long-term care. My parents are a perfect example. They do have good income from retirement, and when they looked at this, they wanted policies that would pay about 5,000 a month. But at 5,000 a month of benefit, it was at that point that they would have to change their lifestyle in order to pay for that. And
right.
so what they did is they changed their data point and said, okay, well, let's purchase 3,000 a month because that's going to be a major help
Hmm.
if especially for home care, if they want to stay
Yeah,
at home instead of going to a nursing home. And so what they bought was not what they actually wanted, but they got a policy that's going to be a substantial benefit to me if I have to start caring for them.
sure.
And so it's something that you can design to fit a budget, but there's just a lot of points to look at. And so we've stayed in the education phase of long-term care over the years. And the reason people buy long-term care insurance is for the same reason they buy life insurance, is because they love their families.
So you think about long-term care, it kind of breaks down into the same categories as life insurance in that a typical long-term care policy, you're going to pay the premiums for life until you have to start using it. And if you never needed it, it's like term life insurance. It's just money that you spent and you don't get it back, right?
Yeah, and for long-term care, I use a different comparison. I don't compare it to term life insurance. I compare it to homeowners.
Ah, your house never burned
Okay.
down. Yeah,
Yeah,
that's true.
that's exactly the comparison because there's no term on long-term care insurance as far
Yeah.
as you can have a policy in effect as long as you pay your premium, just like your homeowner's insurance. And so that's the comparison. And so the traditional long-term care policies are just like that. It's insurance. It doesn't have cash value. It doesn't build wealth. It doesn't have any residual death benefit. Um, but over the past 20 years, most all the companies have seen the advantage of adding the ability to have a death benefit if you never use that policy. And so even the traditional plans now have that option um, to have a
So,
return of all your premiums paid if you never used it.
so yeah, once you kind of walk us through what a new long-term care policy looks like, because I understand hybrids. I want to get into that in a minute, but a traditional policy, I send you these. I think probably once a quarter at least, where one of our clients has purchased a policy decades ago, and they keep increasing the premium, and they really try to talk them into lowering the benefit as well. And then some of these are up to like $12,000 monthly benefit. That's a little excessive, so you can drop your monthly benefit significantly to get the premium down. But with these new policies, are we going to eliminate that 20 years from now, 15 years from now, because we have guaranteed premium options, or is that just something that's extra you have to add to the policies?
Well, I think there's two answers to that question. Number one is I think most companies today are doing a whole lot better in their actuarial analysis of their pricing. Um, Policies that we've sold since 2006 have rarely any of them had any price increases on existing policyholders. Prior to 2004 to 2006,
Mhm.
there was an anomaly in long-term care actuarial numbers because long-term care falls under the life insurance umbrella, not the health insurance umbrella.
Yeah.
So it's subject to state guarantee associations and things like that. But when they started pricing long-term care back in the late 70s, 80s, and 90s, they used the life insurance assumptions to price it. And one of those assumptions was that there would be a 25% lapse ratio. because that's what happens. A person buys a 10-year term policy, they pay their house off, and they drop their policy.
Yeah.
Um, and what they found in the early 2000s was that after a good 25 years of numbers to look at, the lapse ratio in long-term care insurance is less than 1%. And
Makes sense.
so
Yeah.
that was a huge mispricing issue for those policies sold before that. The other thing was that back in the early, especially in the 90s, the inflation protection that was sold to grow long-term care benefits was a 5% growth rate.
Hmm.
And insurance companies had years where they were promising a 5% growth in benefit to their policyholder, and they didn't have that in their portfolio. So
Yeah.
they had to come in and raise their prices. And so I think, number one, companies are doing better today, and we're seeing less of that for some of the newer policies. But the second thing is there's only one company that has a premium guarantee in the industry. So there's not a lot of guarantees out there, but there there are there are protections put in place at the federal level to do what you're talking about, to allow somebody to adjust their policy. And if somebody's watching this and you have a long-term care policy and you've had a rate increase, make sure that you call your agent. Don't just accept it or try to figure it out yourself, because even if they send you some options, I promise you there are more options that you could
Oh yeah.
choose than what the insurance company has sent to you.
Yeah.
And so make sure you call the person that helped you with that, and they can help tell you what to ask for. Um, Personally, I bought my policy in 2004 with a 5% inflation factor.
Hmm.
And in 2011, I got a price increase. And one of those options that I had was to change my inflation growth from 5 to 3. Well, I just made that switch, and my premium went down, Casey, instead of going up.
Yeah.
And so I've been paying less premium for the past 12 years than I did for the first 7 years. And so calling and not being afraid to reach out and ask questions is the answer for folks that have had rate actions on their long-term care plans.
What what do you think is there an age limit, assuming good health, is there an age at which it gets so expensive it doesn't matter, it doesn't make sense?
When you get past 75, it can get really expensive. Um, I've got maybe a handful of clients that are between 75 and 80 when they bought it. But
And is there an age at which you say this is probably, assuming everyone's in good health, this is the age at which is optimal to purchase long-term care insurance?
there is an optimal age. It is when three roads cross. Number one is, do you have something to protect?
Yeah.
And a lot of people don't start saving until they're 55 and they don't have a lot to protect. But we've got a lot of folks that have followed Dave Ramsey's baby steps from when they were 25 years old, and when they're 42, they've got $2 million in the bank.
Right.
So number one, do you have something to protect? Number two, are you healthy enough to qualify for the insurance?
Hmm.
That's the real cost of waiting, is waiting till after you've had a health event and you can't get it, even though you would like to.
Yeah.
So do you have something to protect? Are you healthy enough to qualify for it? And then the third part, which is most important, is, are you at a point in your life where you're ready to budget to pay for long-term care insurance?
Yeah.
I mean, I see a lot of folks in their early 50s that have the first two. They're healthy enough, they've got the money, but they've got three kids in college right now.
Right.
And so it's not the right time. I can tell you that over the past 10 years, the average age has gone down. 10 years ago, our average age was 62. Last year in 2021, our average age was 53.
Oh, wow.
So um, people are beginning to understand the cost of waiting. Um, Not only does it cost more as you get older, but the health part is the critical factor, because insurance companies 10 years ago weren't asking questions for long-term care applicants about your family history. Well, today they are asking family history about Alzheimer's, dementia, cognitive disease. And some companies today will not even take an application on somebody if they've had both parents to be diagnosed with the cognitive disease.
Wow. Okay. So if we think about traditional long-term care, you pay a monthly premium. You choose your death benefit. Or not your death benefit, your daily benefit. Everything is weird. Everything in long-term care is all about the daily benefit. So you just do that times 30, right?
Yeah.
It's how.
Well, that's one feature we might want to highlight here. That's changed over the years. It's now most companies are focused strictly on a monthly benefit and not a daily benefit. And it sounds the same.
Yeah.
If you had $100 a day, well, that'd be $3,000 a month. Well, $100 daily basis is not the same as a $3,000 monthly basis, because with home care, for example, you might not need care but every other day.
Gotcha.
And if that day of care costs you $200 in that day, well, a $3,000 monthly benefit would cover all of that cost, because it's 15 days times $200 a day. Whereas a daily benefit basis would only cover $100 of that 200. And so
take that one more step, because what I've seen on the implementation side is there's different ways you get that too. Sometimes you have to submit a form and get reimbursement. So you have to pay for it yourself and then you get reimbursement. Other times, once you hit a certain criteria, they just start sending you the money every month.
right. And all of the traditional plans, the traditional long-term care plans, are reimbursement plans, meaning that you send a bill in, an invoice, and they reimburse you up to your monthly amount. One of the plans has a cash alternative that we've really seen a lot of people take advantage of, that gives them flexibility. There are some hybrid plans that do exactly what you said in the second case. There is that once you qualify for benefits, they just pay you the cash every month and ask you no questions about it. So those are the two different.
Let's talk about that then. Let's transition into hybrid plans real quick. So this is my favorite plan for typically it's a family of means that's going to be purchasing it. But basically you write one check, or you could draw it out over time if you need to. Let's say it's a $4,000 monthly benefit. It's going to cost you and your wife $120,000 to get the policy, and you write the check for that. It's a lifetime benefit, which is an option, which we've done with the clients through you. And then what I like about it is if you don't need it, then your beneficiaries, your children, would receive the 120,000 ish, give or take, at your death, because you never actually used the policy. So it's not money. Can't look at it as it's not growing in the market. You have to look at it as, well, I've hedged my bets on protecting my assets. But it is tremendously expensive compared to the traditional policy.
Yeah. Well, and for most of our clients that have looked that direction, it's typically, in fact, it was one of our clients that actually framed this phrase. He said, well, this is a self-insuring insurance solution.
Yeah.
Because if I move this $120,000, that's going to be the first money that's spent on long-term care. So it's going to be my money. But what I have done is I have capped my exposure to long-term care to a fixed amount, because after that 120,000 is spent for long-term care, then each of us as a couple have an unlimited monthly benefit, or you could call it an unlimited lifetime income stream to pay for care as long as we need to be cared for. So if we're on that end of the 6 or 7 or 8 year event, then we have protected our state against a catastrophe, while assuming some of the risk ourselves at the same time, rather than assuming all of the risk.
Yeah, absolutely. No, to me, that makes the most sense. You just have to have the cash to be able to move out of your, hey, I need this for retirement income, into protecting of the assets. So there's a threshold at which that makes sense versus doing a traditional policy.
Well, and people may not be aware of this, but most of the companies that have had experience with these kinds of policies over the years have now really shifted. You don't have to do a lump sum purchase. Most of them will allow you to do a 20-year or a 10-year premium payment. Some of them even have a regular annual premium, but you don't have to plop down the 120,000.
Yeah.
That you can keep your money working for you, and you just pay an annual premium for the exact same product.
But it's not the exact same price over time, though, right? I mean, there's a little arbitrage, I guess, on the back end of that for them.
Over time, it would cost you a little bit more, but you also have had access to your own money.
That's true.
During that time frame.
Or ideally, what if you got it when you were 55 and then it was paid for when you retired at 65, and so you did it with your higher wage years as opposed to having to do it when you at least have the least amount of income, overall.
That has become one of the most popular ways to address this, is to get your long-term care protection paid for during your earning years, so that that's not a burden on the budget in retirement.
Right. No, I love that strategy. Well, Randy, we could talk probably for another 30, 45 minutes about this easily, but I know that you have a hard cutoff, and we'll make sure that we pick up where we left off at some point down the road. So thanks for doing this with us today.
Well, Casey, I've enjoyed it. I'll do it again anytime. We just want to help the world get more educated about long-term care. And even as I work with Dave Ramsey fans, that's the objective, is to educate.
Sure.
Because once people understand how these insurance products can work to protect their wealth, then they can sit down and say, okay, this is my need, whether it's for life insurance, or this is my need if it's for long-term care insurance, especially on long-term care if somebody has a parent or a grandparent that has a family history of cognitive disease.
Right.
And so getting that education is really what it's all about. And so.
Well, thanks again. I appreciate it. We'll talk to you soon.
Okay. Y'all have a blessed day. We'll talk to you later.
All right. Bye-bye.
All right. Bye-bye.